I recently made my way to the lumber store. I enjoy doing small woodworking projects, and in this particular case, I was making another set of cornhole boards. And I've made several of them in the past, so I generally know before I go in exactly how much the project's going to cost me. And like everyone else, of course, I've heard the news that lumber's gone up 200 to 300% over the last year, and just building materials in general have gone up. But it wasn't until I was standing directly in front of the rack of 2x4x8s that it really hit me just exactly how much those prices have gone up, because what I was now going to pay for one 2x4x8 was basically what I could used to be able to get three 2x4x8s for. And so it just made me think of the questions we've been getting from our clients around inflation and what that looks like for their portfolio, what it means for their portfolio and their financial plan. So we're going to answer some questions around inflation today, right after this break. So let's just start with the basic question of what is inflation and how is it measured? And basically, inflation is just a measure of the rise in the price of stuff, right? It can be anything from food, electronics, lumber in my case, but basically they're taking a look at what was the price of something last year, what is the price of it this year, and how much has it changed. So oftentimes it is measured in percentages, and when you hear the reports, usually they reference two different percentages. One is the Consumer Price Index, which is CPI, and that just takes a look at a general basket of goods and what was it costing last year, what is it costing this year. And in this particular case, that's what you and I as consumers experience on a daily basis. The other number we will often see reference is the core CPI, or core Consumer Price Index. This is oftentimes what governments or central banks will use to dictate their policy, because the core CPI removes the energy and food prices from the calculation. Because those two areas tend to be so volatile, they don't want to be setting policy based upon that volatility. They want something a little bit more stable. So for their purposes, they sometimes remove those categories for their calculations and their purposes. And another way to think of inflation is if we have 4 to 5% inflation, which is what some of the reports are showing us now. Basically, that means your carton of milk that cost $4 last year is now costing $4.17. And while that 17 cents doesn't sound like a lot, basically you've just taken a 4 to 5% pay cut, because the amount of money you're making today is now going to buy less of what it did a year ago. So that's where you start to see the impact of inflation on a daily basis for you and I as consumers. Another popular question we've been getting around inflation is what exactly or what effect will inflation have on my portfolio? And I think it's important to start off with the idea that inflation, within reason, is actually good for the economy, right? We want somewhere between 2 to 3% inflation is what most economists think is a good, healthy, growing economy. So we shouldn't, as an investor, necessarily be scared of inflation. What we need to be worried about is unexpected high inflation. And that's where stock markets don't like surprises. So if we're anticipating inflation of 2, 3, or 4%, but suddenly, we start to see reports of 5 or 6% or higher inflation, that's when you're going to start to see the stock market respond to that information, probably in a more negative way. But you also have to look at it from the standpoint of what type of investor are you? So generally speaking, a more aggressive investor is probably going to have more stock in their portfolio. So over the course of time, while there's going to be some volatility if we get unexpected higher inflation, the advantage of being a more aggressive investor with stocks is that over time your portfolio will still outperform inflation. So your purchasing power will continue to grow, generally speaking, for somebody who's a more aggressive investor. There are certainly things we can do to optimize the portfolio and different types of investments we can do, but generally speaking, a stock portfolio over time is going to perform above inflation. And so aggressive investors have that slight advantage. Where inflation becomes a bigger concern is if you're somebody who tends to be a more conservative investor. That's where we see inflation potentially having a bigger impact on your portfolio. This chart that you see on the screen in front of you is from a report done by JP Morgan, and this takes a look at $100,000 in the savings account and the interest you would have earned on it over the last not quite 20 years. And it compares it against the amount of income that you need to beat inflation. So if we look back to the year 1995, a savings account in that particular year would have earned, somewhere between $5,000 and $6,000. Inflation would have eaten away at about $3,000 of that. So you would have made, as a conservative investor, just in your savings account, about $2,500 above inflation in 1995. But if you fast forward to 2008, you start to see the trend where a savings account or cash account is not even keeping up with inflation. So while you might be getting your statements and looking at those and saying, well, I'm not losing any value, right? My CD or my savings account has not gone down in value. It has lost purchasing power. And 2007 was the last year where you made enough in a savings account to beat inflation. And so that's where we start to see inflation become a bigger concern for individuals who tend to be more conservative and keep more of their money in cash. So finally, the last question we'll address here is just, what is Stewardship Advisors doing to help you navigate this time period? Some people believe that this inflation is short-term. It's due to lack of supply, right? As industries and businesses had to shut down because of the pandemic. It's not like you can just flip a switch and suddenly production is back to where it was beforehand. And it's going to take a little bit of time until the supply meets the demand. In that case, some people say it's short-term. Other people say the inflation concern is longer term. So what are we doing to navigate this time period for you? And it really comes down to, I would say, 3 different points. Number one, we're going to continuously review your wealth stewardship plan. So if you flip through that document, there's going to be a number of strategies that we are working with you on a regular basis. And those strategies are something we want to review with you each time we meet. Maybe we need to make a change to your investment portfolio because we need to pick some different investments or look at different areas to combat the rise of inflation on your portfolio. Second thing we want to also do is regularly review your financial planning projections. So all of our projections include a certain level of inflation. So if it's a short-term inflation period, we probably don't need to make any changes to our calculations. However, if inflation does go on for a longer period of time, then we need to revisit those projections to see whether we need to make some adjustments to the savings plan or the income plan. And the nice thing about our planning tools is they're all integrated together. So we can really get a good look at how inflation is affecting not just the investments, but also the plan over time and whether we need to change anything there. And then number 3 would just be, and this is a reminder that we tell people all the time, just remember to focus on the things we can actually control, right? We can't control inflation. We can't control how the stock market responds. It's important to be in regular communication with your advisor. We send out those life transition surveys every so often, and there's 52 of those listed on there. And the most important thing we can do is continuously communicate on what transitions you have coming, so that way we have money set aside for you that is going to be able to absorb the rise in inflation if it does come. And so that planning aspect is really where the value of working with the financial planner is going to come into play for you. So hopefully that helped answer some of the questions around inflation. If you have any more, please don't feel hesitate to reach out to us.